after studying this module, we shall be able to understand the concept of marginal costing and direct costing, know the difference between marginal costing and differential costing, learn the concept of cost behavior and various types of costs, and evaluate different methods of segregating fixed and variable costs. Now, we would understand the concept of direct costing and marginal costing. Direct costing is the technique where only direct costs are considered while calculating the cost of product. Indirect costs are met against the total margin given by all products taken together. Many accountants use direct costing and marginal costing as synonymous terms. This is not correct because all direct costs need not be variable costs. A direct cost is a cost that can be identified readily with a department, a function, a unit of product or some other relevant unit. Direct cost can be fixed as well as variable. The cost of product under direct costing and marginal costing will be different. Though most of the direct costs are variable costs, but all direct costs may not be variable. The term variable costing should be preferred to marginal costing as compared to direct costing. On the other hand, under variable costing, we consider only the variable cost for calculating the cost of production and inventory valuation. Therefore, both marginal costing and direct costing are different. Both are techniques of costing which can be used with different processes of costing such as job costing, process costing, etc. Now, we would know the meaning of marginal costing and differential costing. Marginal costing is sometimes confused with differential costing. The term differential costing means a technique used in preparation of ad hoc information in which only cost differences between alternative courses of action is taken into consideration. Therefore, in case of differential costing, a comparison is made between the cost differential among two or more situations and a more profitable situation is selected. The cost difference which is being taken under differential costing may be because of variable costs or fixed costs or both. Hence, differential costing takes into consideration all types of costs, but on the other hand, marginal costing takes into consideration only the variable cost.
Let us consider an example to understand this. Pioneer Manufacturing Company, makers of a specialized line of toys, receives an order for 2000 units of toy battle tanks from a large mail order house at a price of Rs 3 per unit. The company sells this type of toy to its other customers at Rs 5 each, but it has surplus capacity and can take the special order without adversely affecting its regular operations for the coming month. The income statement of the company for the preceding month is as shown here. Net sales is 10,000 units at the rate of Rs 5, that is Rs 50,000. Costs are direct material Rs 1.50 per unit, such that the total cost comes out to be Rs 15,000. Direct labor Rupee 1 per unit, that is, total direct labor cost is Rs 10,000. Factory overheads are rupees 10,000. Selling and administration expenses are also rupees 10,000. Thus, the total costs come out to be rupees 45,000 and the net profit comes out to be rupees 5,000. Direct material and direct labor costs to be incurred on the special order are estimated to be of the same amount per unit as for the regular business. Special tools costing rupees 500 would be required to meet the specifications of the mail order house. We are required to prepare a differential cost analysis for deciding about the acceptance of the order. Let us prepare the differential cost statement. We shall consider two situations. The existing situation having sales of 10,000 units and the proposed situation having 12,000 units. Thus, the total sales is rupees 50,000 and rupees 56,000 respectively. Since we are already given the profit figure of the existing situation, that is rupees 5,000, we shall calculate the same for the proposed situation, that is, when the number of units is 12,000. Here, sales would amount to rupees 50,000 plus rupees 6,000, that is, rupees 56,000. Direct material cost would be 12,000 multiplied by 1.5, that is, rupees 18,000. Direct labor cost would be 12,000 multiplied by 1, that is, rupees 12,000. Factory overheads and selling and administrative expenses would remain the same, that is, rupees 10,000 each. There will be an additional cost on account of special tools of rupees 500. The total costs come out to be rupees 50,500, such that the total profit comes out to be rupees 5,500. Now we shall find out the component-wise net increase or decrease as shown in the column 4, such that the net increase in the profit would be rupees 500. The differential costs are rupees 5,500, while differential sales are rupees 6,000. Thus, acceptance of order from a large mail order house gives an extra profit of rupees 500. The order may be accepted provided it does not adversely affect the present sales at rupees 5 per unit. Thus, in case of differential costing, the change in total costs, both fixed and variable, is taken into account. The term differential cost means the net increase or decrease in total cost resulting from a variation in production. The differential cost is termed as incremental cost when the cost increases and decremental cost when the cost decreases. Thus, incremental costing and decremental costing are two variants of differential costing which are different from marginal costing and direct costing.
To understand the difference between marginal costing and differential costing, some points can be considered. For instance, number 1, differential costing can be used both in case of absorption costing and marginal costing. In case of marginal costing, the entire fixed costs are calculated while in the case of differential costing, such fixed costs which are relevant for decision making are considered. Number 3. Differential costs are worked out separately as analysis statements, while marginal costs may be embodied in the accounting system itself. 4. In marginal costing, the contribution and the profit volume ratio are the main yardsticks for the purpose of performance evaluation and decision making, while in case of differential costing, the differential costs are compared with incremental or decremental revenue as the case may be. 5. The manner of application of differential costing is somewhat different from that of marginal costing. Under differential costing, differential costs of various alternatives are compared with the differential revenues and decisions are taken on the basis of net gain. 6. While evaluating the viability of different projects, making a choice out of several alternative proposals, differential costing helps in a better way than marginal costing. 7. And lastly, under marginal costing, while deciding about the profitability of products for making cost benefit analysis, fixed costs are also considered at some stage. It takes the shape of differential costing. Now, we would learn the meaning of cost behavior and different types of costs. Cost behavior means the reaction of expenses to the alteration in the amount of some business activity. In simple words, how cost is changing where there is some change in the output. Here we can divide the period of operation, that is short term and long term. In the long term, all the costs are variable and changes with the alteration in level of operation, but in short term, all costs do not vary as there is a change in activity within a relevant range. In short term, we have three different kinds of costs, namely variable cost, semi-variable cost and fixed cost. Fixed cost. The definition of a fixed cost is one which does not vary in the total when the level of output by the business does vary. It also follows that when the operating level in a business decreases, the fixed costs would not decrease. Variable cost. Variable costs are those costs which vary when the output varies. In fact, a true variable cost will vary in exactly the same proportion as that of the output. In other words, as sales increase, the variable costs increase. Semi-variable cost. There are the costs which have the features of both fixed and variable cost. It is incurred even when there is no activity as fixed cost and also increases proportionately as the level of activity increases like variable cost.
Cost behavior means the reaction of expenses to alteration in the amount of some business activity. In simple words, how cost is changing when there is some change in the output. Here, we can divide the period of operation, that is short term and long term. In long term, all the costs are variable and changes with the alteration in level of operation, but in short term, all cost does not vary as there is change in activity within a relevant range. In short term, we have three different kinds of costs, namely variable, semi-variable, and fixed cost. Now let's explain cost classification in short term. Fixed cost. The definition of a fixed cost is one which does not vary in total when the level of output by the business does vary. In other words, when the operating level within a business increases, fixed costs in does not increase. It also follows that when the operating level in a business decreases, the fixed costs would not decrease. An example of a fixed cost for a business making a product, such as a bakery, would be the any costs associated with the rent or ownership of premises, insurance, and costs associated with the ownership of equipment. As fixed costs are not dependent upon the level of output, sales, they are often expressed as being per period of time, for example, annually, weekly, or monthly. Fixed costs can be graphically represented as shown here. Variable cost. Variable costs are those which do vary as a total cost to the organization when output, number of items or services produced varies. In fact, a true variable cost will vary in exactly the same proportion as the output. In other words, as sales increase, the variable costs increase. An example of a variable cost for a bakery would be the cost of flour. Semi-variable cost. Semi-variable cost is an expense which contains both a fixed cost component and a variable cost component. The fixed cost element shall be a part of the cost that needs to be paid irrespective of the level of activity achieved by the entity. On the other hand, the variable component of the cost is payable proportionate to the level of activity. It shows similarities to telephone bills. One must pay line rental and on top of that a price that depends on how heavy one is using the service. So, it changes with output. Another example is DTH system. A price for the box must be paid monthly, and to get additional channels, more money has to be given. Cost of energy, such as electricity, is a good example as it is integral to production of goods and services. This component straddles both the fixed and variable universe because electrical power is essential for the basic operation of the business in lighting and heating. This portion is a sunk cost that is foregone regardless of production. As demand ramps up, more energy is required to ramp up the production process in the use of machinery or large banks of computers, for instance. Cost of electrical energy will then rise accordingly as production activities increase. Therefore, the cost of electricity can be viewed as semi-variable. Variable costs can include direct material costs or direct labor costs necessary to complete a certain project. For example, a company may have variable costs associated with the packaging of one of its products. As the company moves more of this product, the costs for packaging will increase. Conversely, when fewer of these products are sold, the costs for packaging will consequently decrease. Variable costs are costs that change in proportion to the good or services that a business produces. Variable costs are also the sum of marginal costs over all units produced. They can also be considered normal costs. Fixed costs and variable costs make up the two components of total cost. Direct costs, however, are costs that can easily be associated with a particular cost object. However, not all variable costs are direct costs. For example, variable manufacturing overhead costs are variable costs that are indirect costs, not direct costs. Variable costs are sometimes called unit level costs as they vary with the number of units produced.
Now, let us understand the meaning of segregation of costs. Marginal costing requires segregation of all costs between two parts, fixed and variable. This means that the semi-variable cost will have to be segregated into fixed and variable elements. This may be done by any one of the five methods. 1. Level of output compared to levels of expenses method. 2. Range method. 3. Degree of variability method. 4. Scatter graph method. 5. Least squares method. 1. Levels of output compared to levels of expenses method. According to this method, the output at two different levels is compared with corresponding level of expenses. Since the fixed expenses remain constant, the variable overheads are arrived at by the ratio of change in expense to change in the output. 2. Range method. This method is similar to the previous method except that only the highest and lowest points of output are considered out of various levels. This method is also designated as high and low method. 3. Degree of variability method. In this method, degree of variability is noted for each item of semi-variable expense. Some semi-variable items may have 30% variability while others may have 70% variability. The method is easy to apply, but difficulty is faced in determining the degree of variability. 4. Scatter graph method. In this method, the given data is plotted on a graph paper and line of best fit is drawn. The method can be explained in some steps such as 1. The volume of production is plotted on the horizontal axis and the costs are plotted on the vertical axis. 2. Corresponding to each volume of production, costs are then plotted on the paper. Thus, several points are shown on it. 3. A straight line of best fit is then drawn through the points plotted. This is the total cost line. The point where this line intersects the vertical axis is taken to be the amount of fixed element. 4. A line parallel to the horizontal axis is drawn from the point where the line of best fit intersects the vertical axis. This is the fixed cost line. 5. The variable cost at any level can be known by noting difference between fixed cost and total cost line. Method of least squares. This method is based on the mathematical technique of fitting an equation with the help of observations. The linear equation such as a straight line equation can be assumed as y is equal to a plus bx and the various sub-equations shall be sigma y is equal to na plus b sigma x. sigma xy is equal to A sigma x plus B sigma x square.
Levels of output compared to levels of expenses method. According to this method, the output at two different levels is compared with corresponding level of expenses. Since the fixed expenses remain constant, the variable overheads are arrived at by the ratio of change in expense to change in output. Let's consider an example to understand the levels of output compared to levels of expenses method. The information for the 2 months, that is, January and February, is given as shown in the table. The output is 5,000 units and 6,500 units for the months of January and February respectively. The total cost is rupees 1,10,000 and rupees 1,25,000 respectively. We are required to find the fixed cost per month and variable cost per unit. Number of units is being increased by 1500 and cost is being increased by rupees 15,000. By following the level of output method, we can find out per unit variable cost by dividing the change in cost by change in output. So, variable cost would be 15,000 divided by 1500 is equal to rupees 10 per unit. Now, as we have variable cost, we can compute fixed cost by deducting total variable cost from total cost. Fixed cost is equal to total cost minus total variable cost. Fixed cost for January is equal to 1,10,000 minus 10 multiplied by 5,000, that is rupees 1,10,000 minus 50,000, which comes out to be rupees 60,000. In the same manner, we can get fixed cost for February.
Let us now recapitulate what we have learnt in this module. In this module, we have learnt about marginal and direct costing. Both the terms are used synonymously but have different meanings attached and cannot be used interchangeably. Marginal costing considers only the variable costs for calculating the cost of production and inventory valuation. On the other hand, direct costing is the technique where only direct costs are considered while calculating the cost of product. We have also learned different methods for segregation of fixed and variable costs.
Let us summarize what we have learnt in this module. In this module, we have learnt about marginal and direct costing. Both the terms are used interchangeably but have different meanings attached and cannot be used interchangeably. Marginal costing considers only the variable costs for calculating the cost of production and inventory valuation. On the other hand, direct costing is the technique where only direct costs are considered while calculating the cost of the product. We have also learned different methods for segregation of fixed and variable costs. Cost behavior means the reaction of expenses to alteration in the amount of some business activity. In simple words, how cost is changing when there is some change in the output. In short term, we have three different kind of costs, namely variable, semi-variable, and fixed cost. The definition of a fixed cost is one which does not vary in total when the level of output by the business does vary. It also follows that when the operating level in a business decreases, the fixed costs would not decrease. Variable costs are those which vary when output varies. In fact, a true variable cost will vary in exactly the same proportion as the output. In other words, as sales increase, the variable costs increase. Semi-variable costs are the costs which have the feature of both fixed and variable costs. It is incurred even when there is no activity as fixed cost and also increases proportionately as the level of activity increases like variable cost. We have also learned different methods for segregation of fixed and variable costs. This may be done by any one of the following methods: levels of output compared to levels of expenses method, range method, degree of variability method, scatter graph method, least squares method.